Hello, I'm Steve Balch, the Director of Wealth Management and Financial Planning at Certa Financial Planning, here to give you our monthly market update for September. After months of no change to our macro stance, we have made two changes for September. The first is an upgrade to the Fed policy, as the Fed has signaled that it will start cutting this month. The second change is a downgrade to economic leading indicators to neutral, as manufacturing data came in weak. The jobs report had a downward revision of over 800,000 jobs year over year, and wages have started to stagnate. As for the other indicators, they remain the same, with the market trend and fiscal policy remaining positive and valuations continuing to be neutral. For the market regime, we continue to be in a Goldilocks regime, with stocks and bonds both seeing gains. This regime occurs when there's economic growth with falling inflation, making it a risk-on environment. In regards to the business cycle, the US economy has moved back in the business cycle as it shows signs of both mid and late cycle stages. Recession risk in the near term continues to be muted, even as job creation, worker sentiment, and wage increases have all moderated in the recent months. On the positive side, business investment and labor market productivity remain in an upswing, while consumer balance sheets remain healthy. These are the three questions we'll be monitoring going forward. Is the August panic over? How much will the Fed cut? And keeping with the election, which party is better for your portfolio? August started with a sharp decline and panic in the market when the markets feared the Fed was behind on rate cuts after a weak manufacturing report. Calls for emergency cuts, as well as a 50 basis point cut in September, were plentiful. However, after the Bank of Japan came out and said they would not raise interest rates further than the 25 basis point hike they did in August, markets rallied back and finished positive for the fourth straight month, continuing a seasonal trend of being positive in election years. With the anticipation of the Fed ending its restrictive interest rate environment, investors are going into September with a positive outlook. However, it's good to note that we have never had an election year where June, July, August, September, and October are all positive. Historically speaking, September and October tend to be volatile months, especially in presidential election years. Now, trends do not always hold up, and we have had a relatively calm year in the markets, but it is possible we see more volatility in the coming weeks. As for the Fed, they signaled in their August meeting that a shift in policy was warranted and rate cuts were coming at their next meeting. The question we'll be watching is how much they will cut. Early concerns about the Fed being behind the curve had markets anticipating a 50 basis point cut in September, but expectations have since leveled out, with the market anticipating a 25 basis point cut in a couple of weeks. The market does expect the Fed to lower rates a full 100 basis points, or 1%, by the end of the year, meaning they do expect a 50 basis point cut in either November or December. With the Fed shifting gears, how much they cut and what they say the plan is going forward will be what everyone is watching for at the September meeting. Lastly, with the election about 60 days away, we know that there will be a lot of headlines and noise between now and then. However, we want to remind you to not let your political views hinder your investment strategy. Going back 70 years, had you invested $1,000 under one political party, you had done slightly better under the Democrats, with that original 1,000 investment turning into a little over 61,000 versus a little over 27,000 for under Republicans. If you ignore the noise, though, and stayed invested regardless of the party in power, that $1,000 original investment would be $1.69 million today. The point is to remind you that elections and parties don't determine market outcomes and business successes. Businesses adjust the policies and will continue to earn profits under each party. There will always be noise. The key is to build a plan and stick to that plan. How are we positioned in our outlook going forward? Our model shifted in early August to overweight growth strategies, causing our tactical and alternative strategies to be downgraded to underweight. We continue to stay neutral on preservation for now. As discussed earlier in this video, it is possible we will see some volatilities in the coming weeks, as historically, September is the most volatile month. It is good to note, though, that September volatility typically doesn't show up until the second half of the month. Nevertheless, if we do see a correction in the coming months, we will adjust accordingly and look to rebalance. We want to assure you that these corrections and market pullbacks are all normal and the trend continues to be positive, especially in this election year. For now, we continue to monitor the markets and rely on our internal research as we stay the course. We thank you for watching. As always, please feel free to forward this to anyone you believe can benefit from the information. If you have any questions, please feel free to reach out.